I'm about to show you how to find undervalued stocks that actually go up when you buy them. And this is the same strategy I use to take my net worth from $0 to $130,000 in less than 3 years. It all comes down to a 3-step concept strategy I use to find, research, and qualify companies that 99% of new investors never look at. Because when you understand how the world's smartest investors find these hidden gems, you'll be able to copy them and do the same. So in the next 15 minutes, I'm going to go over a new way of finding these undervalued companies on platforms like Yahoo Finance. Then we'll go into which financials you should look at step by step, what to look for, and common red flags to avoid. And then finally, we'll go into how to actually know whether or not they will go up so you can make an educated bet that almost always pays off. And this is the same strategy I've done with my own new portfolio to take it from $4,000 to $6,000 in the last 3 months. And this strategy can work for you even if you're a total beginner, regardless of where you are in the world. Because I'm on a mission to help 1,000 people make their first $100,000 from investing in stocks and debunking the myth that you can't beat the S&P 500. Let's dive in. The average investor is bombarded with a ton of information nowadays and end up deferring to experts because they simply don't know what stocks to buy. So they'll tune into CNBC and pick stocks off of what Jim Cramer says on Mad Money, oftentimes making the wrong move because they simply don't know any better. Imagine you're considering investing in a company, but there's a confusing sea of numbers in front of you. How do you make sense of it? What if I told you there's this method to the madness? 99% of new investors don't know about this common concept, but armed with it, you can increase your odds of making money from week 1. This concept is like a magnifying glass that helps you uncover the truth behind the numbers and spot winning investments or avoid potential disasters. And this concept is financial ratios. Okay, let's get grounded. So what are financial ratios? Simply put, these are calculations that take information from a company's financial statements to provide insight into its performance. They can help you gauge profitability, liquidity, and risk, all critical factors when deciding where to invest your hard-earned cash. Two crucial ratios to consider are the price-to-earnings ratio and the price-to-book ratio. The price-to-earnings ratio, or the PE ratio, tells you how much investors are willing to pay for a dollar of earnings. A lower PE compared to industry peers can indicate a stock is undervalued. Let's break it down further. So imagine you're at a bake sale, right? You see 2 tables. Table 1, amazing cookies, but they're asking for $5 a piece. Table 2, same delicious cookies, but only $1 each. That's kind of like the price to earnings ratio here. It basically tells you how much you're paying for every dollar of profit a company makes. High PEs, like those $5 cookies, means you're paying a lot for each dollar of earnings. Maybe these cookies are expected to be super popular and they sell out fast, so they're priced higher. And in the stock world, this could be a company everyone thinks will grow a ton in the future. So there's more demand for it. And this drives the price you pay for every dollar of earnings higher. Now, low PEs, like those dollar steals, means you're getting more bang for your buck. Maybe these cookies are just as good, but the baker is new and needs to attract customers. With stocks, it might be a solid company that's overlooked or undervalued right now that could potentially be in the same sector and growing just as fast as the high PE ones. An important note though, just like cookies, there are other things to consider. Maybe the $5 cookies are huge or the dollar ones are kind of small. With stocks, you got to look at the whole picture, the company's growth, debt, and what it actually does before you actually buy. But in general, a lower PE can mean you're getting a better deal, like those delicious cookies that cost $1. You can now buy a whole bunch of. Similarly, the price to book ratio, or the PB ratio, compares the company's current market value to its book value. A PB ratio under 1 often signals an undervalued stock. Let's break it down with an example. Let's say you stumble upon a yard sale with 2 identical vintage record players. Record player 1, the owner wants $500 for it. Record player 2, the owner is only asking for $100. But hold on, you open them up and you see that record player 1 has a rare limited edition Beatles album, while record player 2 is empty, and suddenly that $500 price might make more sense, right? That's kind of like the price to book ratio. It compares a company's stock price to its book value. Basically, all its stuff, buildings, equipment, cash, etc., would be worth if they sold it all off today. A high PB, like that pricey record player with the Beatles album, means the stock price is much higher than the company's stuff alone is worth. This could mean investors think the company has a lot of hidden value, like strong brand, future growth potential, or secret recipes for amazing products. A low PB, like the cheaper record player, means the stock price is lower compared to the value of the company's assets. Maybe it's a solid company that's been overlooked, or maybe there's something making investors less excited about its future. Now, important note as well, just like with the record players, you gotta look beyond the surface. Maybe the $500 player is actually broken, or the $100 one is a rare model in disguise. With stocks, you need to consider things like the company's management, its industry, its overall financial health, and much, much more. But in general, a lower PB ratio might suggest a company is undervalued, a potential bargain waiting to be discovered. All right, so the stock market can be like the wild, wild west for new investors who don't know any better than buying a stock they heard their friend brag about, maybe in the bar, that made them $10,000 in 30 days. In essence, a newbie is better off learning the ropes of one of the most important approaches to evaluating companies' health and potential. This approach helped me buy this stock that has made me almost $10,000 in profit alone in 180 days, a 61% return. This approach is analyzing business fundamentals. You'll start by asking, how do they sell the products? Is it in stores? Is it on an online or at a farmer's market? How do they acquire their customers? Is it through Instagram or TikTok ads, TV ads, or something completely different? The next thing you want to ask is how their financial health is like. What are their revenues? What are their profit margins? How are their debt levels? And another crucial question to ask is the industry they're in. How is that industry performing? How about their sector? Is it growing? Is it declining? Things like that. Let's explain it with 5 simple terms using an example of a donut shop that you and I own. Number 1, show me the money. Revenue is how much money the shop brings in from selling its donuts. Think of it like your allowance. The more you get, the more you can hopefully save and spend wisely. Here you simply want to look for companies with growing revenue, which directly means that they're popular and people want what they're selling. As in the case of our donut shop, the donuts are so famous, even cops from out of state are even coming to buy them. Number 2, are we actually making dough? Okay, so the donut shop is making money, but how much are we keeping after paying all the bills, paying the employees, and stuff like that? That's the profit margin. Imagine half a dozen donut box sells for $50, but it costs $10 to make them. Our profit margin is 50%. Pretty good, right? Similarly, with buying a company stock, you want to look for companies with healthy margins. It means they're running their business efficiently. Number 3, not all borrowed sugar is sweet. Just like we might borrow money from a friend to buy that new secret donut ingredient that might make cops even from Europe make the trip to have our donuts across the world, companies sometimes take on debt. A little debt can be okay, but too much can be risky. It's like us owing our friend so much that we can't afford to buy anything else. In real-world investing, check how much debt a company has compared to its income to help you make a decision on its financial health. Number 4, the donut chefs. We can have the best ingredients for our product, but if our chefs, aka the management team, are clueless about what they're doing, those donuts will be an absolute bust. Same case, you want to look for companies with experienced leaders who have a good track record of leading people and making profitable bets. Number 5, the donut shop vibe. Even the best donut shop might struggle if it's located in a town where everyone's suddenly obsessed with bagels. Similarly, a company's success is tied to its industry. Is it a growing industry with lots of demand? Or is it fading out of fashion like Jerry curls? A bonus tip for you, don't forget to check out the competition. Are there other companies making better donuts? /products or selling them cheaper than us? To summarize, you want to look for companies with solid balance sheets, consistent cash flow, and strong management teams. Reading quarterly earnings reports and understanding the competitive landscape will give you clues about the business's potential. Don't just look at the numbers. Ask yourself, does this company have a product or service that stands out in the market? Remember, investing is like building a balanced donut box. You want a variety of flavors and styles. Don't put all your eggs or donuts in one basket. Do your research, compare companies, and maybe even try a few taste tests or small investments before you go all in. All right, to cap off the 3-step process, we have the third and last concept that everyone and their grandma in the world knows, but somehow 99% of new investors I've worked with seem to overlook. This simple concept has been used since humans started trading with each other and will always separate winners from losers. It's used in sports, business, politics, heck, even in relationships when someone is choosing a partner from a myriad of choices. The single idea is the reason why people like Elon Musk, Mark Zuckerberg, Jeff Bezos, and billionaires around the world get into and stay in the Forbes list. This concept is simply competitive advantage. In simple terms, it's what sets a company or person apart from their rivals. In the case of investing, think of it as a company's unique selling proposition, a factor that gives them a leg up in their industry, and it could be anything from a patented technology to a loyal customer base, or even the best management team. We've been using a secret ingredient that makes their pizza insanely delicious. Plus, they deliver by drone and have a loyalty program that gives you free tickets to to see your favorite artist. That secret ingredient and those cool extras, that's their competitive advantage. What sets them apart from and makes them better than the competition. Here's 4 important points to know what matters when you're checking out a company's stock. Number 1 is the moat to succeed. A strong competitive advantage like a moat around a castle protecting a company from its rivals. That's a term Warren Buffett used to describe how he looks for companies to invest in. It's as timeless as the man himself. Think of Apple's brand loyalty or Amazon's massive delivery network. It's tough for others to copy that. Number 2 is pricing power. If everyone craves that secret ingredient pizza place B can charge a little extra, right? Companies with a competitive edge can often raise prices without losing customers. It was crazy to think in the mid to late 2010s that a smartphone can cost $1,000. But when Apple raised their prices, this didn't deter customers. Instead, more and more people began buying iPhones because it stopped just being a phone and became a status symbol because of its value. Apple can raise prices tomorrow for any of their products, and people will still buy them at whatever price because of number 3, which is customer love. People keep coming back for more when a company offers something unique or better. That means loyal customers and steady profits. A perfect example to explain this is Samsung Android smartphones, which topped the iPhone in 2024 in sales. Lastly, number 4, which is staying power, means trends come and go. Remember fidget spinners? But a solid competitive advantage helps a company stay on top for the long haul. Think about a company like Nike or Adidas, which are brands synonymous with staying active. As long as humans stay active, these companies are never going anywhere. As a bonus for you for sticking with me until this point, here are 4 more secret ingredients companies might have that you should take a look at. Number 1, brand recognition. Think Coca-Cola. I think everyone in the world knows what Coke is. Number 2, low costs, like Walmart or Costco, which enable them to offer the lowest prices, which is a powerful edge. Number 3, technology. So companies like Tesla with cutting edge tech can stay ahead of the curve. And the last one, the network effect. The more people use TikTok, the more valuable ByteDance, the company that owns TikTok, becomes. The bottom line is, when you're looking at a company's stock, don't just look at the pizza. Look for that special something that gives them an edge in the pizza wars. It could be the key to finding companies that deliver delicious returns for years to come. Now you know the strategy I used to take my net worth from 0 to 130K in less than 3 years. But you've got to always be aware that building and managing a successful portfolio takes time, effort, and expertise. It requires continuous learning, constant monitoring, and the ability to navigate the ever-changing market landscape. We give away information that you need on this channel so that you can grow your portfolio from 0 to 1, 10, and eventually 100K for free. There's more gems that I share on this channel to help you get started with your investment journey and learn more about stocks. So go ahead and click this video here to get more valuable insights. Thanks for watching and have a great day.